Hello everyone, I am Pratap here. We are at the second part of lesson 29.8. So this is continuation to the previous 29.8.1 lesson. In this video, we are going to focus equity chart versus future chart. Because we are analyzing on the equity charts and taking trades on the future charts. And why we are not analyzing future charts. All these concepts you should understand. And this video is having dependency on the earlier lessons. In case if you did not complete earlier lessons, I provided the link to all our training lessons in this video description. So go to the video description and start learning from lesson 1.1, but according to my training instructions. My training instructions are available at our Telegram channel. I also provided the link to the Telegram channel in this video description. Join at the Telegram channel, go to the pinned messages. There you can find all the training instructions. Okay, now, first of all, why we are not planning our trades on the future charts? See, this is the equity chart. And this is Sri Cements. Yesterday we discussed this chart. And if you go to futures chart, let me open futures chart, Sri Cement futures. So this is a futures chart. And this is equity chart. Is there any difference? Looks like similar, but there is a difference. Some price differences will be there. See the close of this candle. What is the close of this closing price? 30,245 rupees. That is in futures chart. But what about equity? 30,055 rupees. See, equity closing price is 30,000. This candle, the candle morning 9:15 candle on 25th April 25. The closing price of equity chart is 30,055 rupees, but at the same time the closing price of the morning 9:15 75 minutes candle is 30,245 rupees in futures. So we have a difference, a huge difference. So why? What is the reason for this difference, price difference? The reason is premium will be added to the future prices. And these premiums will be changing. Basically, it will come down when the prices are nearing to the expiry date. Initially, at the starting of that month, the premium value will be a little higher, and the value gradually it will come down, and on the expiry date the futures price and equity price are almost same. So why these premiums are getting added? Because you know the futures concept, right? We are predicting the futures price. Maybe you are assuming maybe futures prices may go up or may go down. By keeping that point in our mind, and you are buying in advance. So that is the reason why some premiums will be added to you. For the risk management point of view, premiums will be added. How do these premiums will be calculated? We have a formula for calculating this premium. See the futures price, this is the formula to calculate futures price. But always remember, futures price calculations will be depending on the underlying asset price. What is underlying asset? Your equity. Equity is the underlying. Suppose Sri Cements, that is the equity chart. That equity is having a future. So for the Sri Cement futures, Sri Cement's equity is the underlying. So the underlying stock prices, that means equity chart prices, will influence the price changes in the futures. But premium will be added to the equity price. So that's why equity price is called as spot price. That is nothing but your equity chart price. So For the spot price, this formula value will be multiplied. Whatever the value this formula is giving, that will be multiplied. And whatever the value is there in this formula, that is called premium. We call that as whatever the value you get, that is premium. And the formula is like this, 1 plus risk-free rate. So this is the risk-free interest rate. So you can find the risk-free interest rate value at RBI website. These values won't be changed every day. It is a fixed value, but once in a while, maybe every 6 months or 1 year, the values may change, or any sudden policy changes. At the time, these values will be changed. Risk-free interest rates. That should be multiplied to this days to expiry divided by 65. Days means how many days remaining for the expiry of your futures. Your future. We have a current month future. We have next month future, we have 4 month future, right? We have 3 months, 1 month, 2 months and 3 months. So how many, whichever the future you buy, are you buying current month future, are you buying next month future, are you buying the 4 month, that is 3 months future? From today till, suppose you are buying 3 months future, 3 months back, it is after 3 months, it is going to expire. So starting from today till the expiry days, how many remaining days are there? Expiry. Those days you have to specify from today. For example, if you take current month of futures, from today till the end of the ongoing current month, how many days left? Those days you have to specify here. Calendar days. It's not trading days, the calendar days. So divided by 365. Suppose any dividend will be there during this month. So the dividend value also you should add. Otherwise, dividend value will be 0. So this formula gives you, if you apply this formula, it gives you a value. That value is called premium value. And that value will be multiplied with spot price. Sorry, you get a value. We can't call that as a premium value. Whatever the value you are getting, you spot price. Now that whatever the new future value you are getting minus that spot price value, that is going to be premium value. The future price value minus spot price value with after this formula. You get the premium. But the premium should be constant within a day, right? According to the formula, because it is a fixed value. Because within the day, the risk-free interest rate may not be changing the same day. If rarely this value will be changing. And the days will be changing next day only, remaining expiry days. Throughout the day, the days to expire is a fixed value, right? Suppose there is no dividend declaration, that is till the dividend, the value is going to be 0. That means throughout the day, the future price and spot price, any time if you subtract, the value should be same, right? But unfortunately, that is not the case. Why? Because apart from this, the current market volatility will also influence at some extent. But that is a negligible value. Why I am saying negligible? The difference may be less than 2%, not more than that. Sorry, 2% is a huge value. 0.2%. Sometimes 0.1% it will be. But okay, at high level let us keep. Generally the difference you see less than or equal to 0.2%. 0.2 is almost negligible. See, when you are expecting 2% or 3% profit, in that 0.2 change might be negligible. You don't really bother. So that's why, to make you understand, let us compare future chart and equity chart price differences. Let me open 1 minute chart to bring you better clarity. So this is a 1 minute chart of Sriram Cements. Sorry, Sri Cements, not Sriram, Sri Cements. This is the futures price. And also this is equity. Here also let me change the time frame to 1 minute. So here we got a trade, right? Friday we got a trade here at morning 9:27 candle. Here market started morning 9:15. There was some small movements and then reached the entry, and here it pushed the prices down. This is what we discussed yesterday. How exactly you need to plan your trades in future by using equity analysis, that I will discuss after completing this current discussion. First, the goal is to compare the futures prices and equity prices. Now go to the equity chart. 25th morning 9:15, where it is. This is 24th April here, yes. See here, this is morning 9:15 candle. This is on futures chart. What about equities chart? This is the morning 9:15 candle. So in my comparison, what I am going to do, morning 9:15 higher value in equity chart and morning 9:15 high value, day high value in futures chart. Let us compare. What is the high of this candle, morning 9:15 candle? This is in equity. This is the high value is 30,830. Here high value 31,090. So what is the difference? 31,090 rupees minus 30,830. The high of this candle is 30,830. Subtract both the values. Then you see the difference between at the highest of that particular candle high. What is the difference? Those values I calculated here. I marked it. See, morning 9:15 time interval, that particular candle high price value between equity chart and futures chart difference I have seen. That's why the heading I kept future price difference between future and equity charts on 25th April 2025. But as I told you, candle is having open, high, low, close, right? Okay, it is up to your wish. You can compare the difference between closing price or day low price or day high price or even open price. I have selected randomly high price. Morning 9:15, the highest price difference. So what is that I told you? The difference between the high of the candle. This is the one. And also this is the 9:15 candle. The high of the candle 31,090 rupees. 31,090 rupees minus here equity chart high of the candle is candle high 30,830. Morning 9:15 candle 30,830. The difference is 260 rupees. Generally you see in any day 9:15 candle you see huge difference. 9:15 candle. Why? Because 9:15 candle volatility in the market is very high. As I told you, the volatility is also influencing futures prices. It's not just depending on that formula. To that formula, some more additional premium will be added, or additional premium slightly from the premium value, slightly it will be reduced. It is all because of changes in the volatility conditions in the market. And that change will be mostly less than 2% within the day, except the 9:15 candle. 9:15 I am not considering, because 9:15 volatility is unpredictable. So that's why always we avoid our trades in the morning 9:15 candle. So that's why, see, compare the whole day. Most of the time, maybe 9:17 candle is an exceptional. Here very less difference has got, but most of the time, see, the price is between 100 and 150. Most of the day. See, here you have seen least 100. I calculated up to 10:30 because 10:30 candle we closed the trade. That's why I calculated up to 10:30. If you see the difference, most of the difference is around 50 rupees difference between 100 and 150. See, here we have 150 most of the day. Here 260 is extreme. Generally morning, first 3-4 minutes you see huge volatility changes in the market, and 9:15 extreme level you see. That's why 9:15 candle we are avoiding trades. But remaining times you see the difference. At different candles I calculated. 9:15 to 9:20 I calculated. After that randomly I have selected some prices. 10 o'clock, 10:20, 10:30. Like 10 minutes gaps I have taken, and 10:31 candle I think we closed the trade. That's why I selected what is the difference between equity price and let us assume if you apply the formula, the value is 125 average value. Let us assume. So 25 rupees, either it is reduced or 25 rupees it moved up throughout the day. So plus or minus 25 rupees. And what is the value of 25 and the price of Shriram Cement? Let us go to the Shriram Cement chart. Shriram Cement chart, maybe see here we closed the trade. This is 10:31 candle. In between, let me take an average price somewhere in the middle. Say 30,490, let me say 30,500. Some round value I take. All of you observe what is the calculation I am doing. What is this calculation I will explain. First observe the calculation. $30,500, right? Average value I am giving 30,500 into 0.2 divided by 100. Why 0.2 I am giving? I told you most of the time the volatility differences in the futures price compared to that average price, assuming that average price could be the premium value, what we are getting by deriving from the formula. From that formula, whatever the price we are getting, I am telling you the price movement towards the higher side or lower side is not more than 2% because of the volatility changes. Not 2%, 0.2%. 0.2 is a negligible percent. It's almost negligible. 0.1 or 0.2. See, many times for taking the trades, we are using entry buffer. How much we are taking? 0.1%. Why 0.1% we are taking? That is a negligible amount, not much. That difference. Even if you lose a 0.1% or even 0.2% from your profit, you won't really mind for that. Because the value is a small value, that is okay. That is how you feel. Exactly the same thing happening even in futures also. Something wrong value I entered here. Okay, sorry. 30,500 into 0.2 equal to 6,100 divided by 100. 100 means the percentage. 0.2%, that is 2 by 100. Sorry, 0.2 by 100. That equals to 61 rupees. That means from the derived value using this formula, whatever the value you get from this derived value, during the day 0.2% we added, either 60 rupees upside or 60 rupees downside, you may see some movement because of the volatility changes in the market within the day. You may say 61 is a big value, right? 61 is not a big value compared to 31,000 rupees stock. Maybe if it is a 100 rupees stock or 1,000 rupees stock, 61 is a big value. But 31,000 rupees worth stock, 61 is a negligible. It is only 0.2% value. The 60 is 0.2% value of your Shriram Cement share value, that 30,000 worth value. So remember, 61 you should not see in terms of the number. You have to see percentage value. The 61 is equivalent to only 0.2%. Got it? Okay. So 60 rupees up or 60 rupees down. Let us assume average value 125. let us assume the premium value. This is an assumption. I am not doing exact 100% accurate values. Those who are having interest, apply this formula and derive the value. For that derived value, you see some 60 rupees upside, 60 rupees downside. By seeing all these values, especially by ignoring first 3 or 4 minutes data, remaining days data, the movement I have seen till 10:30. Prices moved between 100 and 150. In between only they moved. Maximum how much they can move, let us assume if it is 125 rupees, 125 plus 60 rupees or 125 minus 60 rupees. The movement should be within 0.2% level. In this stock, even 0.1% means half of 60, that is 30 rupees. So within the 30 rupees only the prices are moved for this stock. Maybe some other stock, volatility could be a little higher. Maybe you may see up to 0.2%. But Sri Cement, the volatility within the day is within 0.1% level. Add 125 plus 30, 155 you will get maximum. See the maximum value within this period you got only 150 rupees. Similarly 125 minus 30, you get 95. But least value you have seen 100 here, morning, that too in the morning hour. Rest of the day, the value is less than or equals to 110. So that's why this small movement, it doesn't really impact your overall trading strategy. This is what you have to understand. So keeping this point in mind, what is the strategy I am applying while trading in futures? You are analyzing equities chart only, but futures chart you are not analyzing. Why we are not analyzing futures chart? Because of this premium value and the volatility changes influencing the prices. Influencing the premium value. Influencing the price that comes under demand and supply, but they are influencing the premium value. So this is the reason why we are avoiding our analysis on the futures charts. Because of these premium changes, what is happening, sometimes you see spikes above and below your zones. It looks like your trade is stopped out, but immediately prices turn back and again it will reach our target. The danger is there in futures. That's why futures charts we don't. And moreover, according to this formula, at the beginning of the month, you get a higher premium value, and the ending of the month, you get a low premium value. Because of the higher premium value, month beginning zones will be forming at high value, month ending zones will be formed at the lower value because of the premium differences. Suppose month end is without a premium, a zone is formed. Month end, a zone is formed. Let us assume. Next expire, that month expiry is completed. Next month futures are started. Next month futures premium value is very high. And price, when it is reaching to the zone with a heavy premium value, the zone will be violated just because of the premium value. Earlier, month ending zone was created almost zero premium value. Then immediately month is changed, premium value is increased, maximum premium value will be there. If suppose if price moves moving towards the zone, price is moving to the zone with higher premium value. Because of that premium value, zone will be violated. And then prices will be coming down with zone violation. Because zone is violated, what you do? You will exit from your trade. But actually zone is not violated. Premium value created an impression that your zone is violated. Such kind of differences you can't see in the equity charts. That is the reason why we have to analyze equity charts. Because equity, if you go to the equity charts, there is no premium value here. But here you will be having a premium value. Because of the heavy premium value, sometimes zone may be violated. Sometimes it looks like it gave you excellent trade sometimes. So that means there is no consistency. Anyway, whatever it is, we got the trade here. When we got the trade, how to trade in the future? See, first, while prices are entering into this, so this is the question most of you will be having. When prices are entering into this zone, which chart you are analyzing? Equity chart. Okay, now about to enter, just a few paisa before entering into this zone. Few paisa, generally you add entry buffer, right? Few paisa entering into the zone. Whatever the price is there in the equity chart, which candle you got the trade? 927 candle, right? 927 candle. In 927 candle, where it is? Here. When price is in the 927 candle, you just take the trade here. See, this is about to enter here. Before just entering into the zone, go to the equity chart, probably here. Before entering to the zone, let us assume this is the price. Just before entering into this zone, let us assume this is the price in morning 927 candle. Whatever the price, take the trade with that price. You just take the trade. What about stop loss? Can I keep my stop loss here? You may say, no, don't keep any stop loss here. Your analysis will be on this only. Suppose prices are moving up, and it is hitting your stop loss. The moment it hit the stop loss, whatever the price in the futures chart, with that price, you exit your trade. You don't bother about what is happening in future. Exactly at the time of hitting the stop loss here, whatever the price, with the same price, you exit. Okay, while exiting, you add some buffer, maybe some 10 paisa or 20 paisa, or if it is 30,000 rupees worth stock, maybe 1 rupee. You add that buffer, go for a market limit order. Don't go to the market order. Market order is very dangerous. Go to the limit order. Why market order is dangerous? Sometimes what happens, some spikes will happen in the software system. Because of spikes, if somebody keep a trade at very low value or high value, systems will execute those trades. Generally, that kind of mechanism is called freak trade. I don't know how many of you are aware. Just search in the Google, freak, F-R-E-A-K, I think spelling. Please correct me if it is my spelling is wrong. It is not a free trade, it is a freak trade. Okay, so that freak trade happens because of some glitch in the system, software systems. That is a known glitch, because when some lakhs of volumes are there, nobody can avoid such kind of software glitch. It happens. It's a known thing. So that's why people keep market order. Whatever system suggests, the trade will be executed. Because somebody kept a trade here, just above that somewhere. When somebody keeps a market trade, their trade will be executed. Because market trade means whatever the price you suggest. You are telling the software system, whatever the price you suggest, that price I want to sell. That is how you are telling the software. If software decides far away from your stop loss, if price is executed, how much stop loss you will be executed? Huge loss you will be getting. So that's why don't go to market trades. Go to the limit trades. Limits means you specify. But while using limit trade, suppose at this time the price is 30,953. Or maybe here it is 30,110 or something, your stop loss. Maybe somewhere here it is 31,146. At that place, 31,146. Add one or two rupees below and you exit your trade. Of course, you get 1 rupee extra stop. 1 rupee extra money you will be losing. 1 into 25 is 25 rupees additional money you will be losing. Okay, it's okay. 25 is a small money only, compared to the money invested 1.5 lakh for buying this stock. So you should not compromise at the 25 rupees or 50 rupees or maximum 100 rupees level. Even if you lose some 100 rupees extra money than your actual money, it's okay. That is what I am trying. But your goal is your trade has to be executed. And one more thing is, one more problem with the futures is, some of the stocks, liquidity is low. When liquidity is low, your trade may not be executed. That's why when low liquidity trades, better you avoid those trades. Instead, you go to equity chart and do trading in the equity chart, intraday trades. But if you are going for DIT trades or WIT trades in futures, you can't go for intraday related cash trades. You can't take for short trades. Cash trades for short trades is supported only intraday. That too, those trades you have to close before 2:30 or 2:45. That is another disadvantage. Future you have advantage is even at 3 o'clock 29 minutes also you can close your trade, provide the stock should have liquidity. The liquidity is not there, you want to sell but there are no buyers, your trade won't be executed. The danger will be there. Such kind of stocks you have to identify and don't plan your trades in futures. Futures, whichever the stock you want to plan, make sure there is enough liquidity is available. And how do you know the liquidity? Look into the volumes of futures. Every minute-wise volumes, good volumes are there. You say, for example, Infosys, Wipro, TCS, all Nifty 50 stocks. I won't say all Nifty 50. Some Nifty 50 stocks might be having some 1 lakh rupees price and they might be having less liquidity. So that's why look into the volumes. If volumes are good, go for futures with confidence. Anytime you want to sell, you buy or sell, you get either buyer or seller you get. But if the liquidity volume is in just few hundreds, if you are planning trade, sometimes nobody buyer you won't be getting, a buyer or seller. So this is one disadvantage with futures. Okay, intraday traders, at least you have solution. You can go for short trades in cash segment itself. But that is not possible for DIT trader or WIT traders or MIT traders. So those traders, those who wants to trade in cash segment, in future segment, make sure the liquidity in your stocks are having enough liquidity. That you can find with the help of by seeing the volumes. Your chart will display the volumes, right? See here, my chart is displaying volume. If you don't know how to add volume, here you go to indicator. In the indicator, you type volume in trading view. You get a volume, click on this volume, it will be added here into your chart. That way you can understand what kind of volume your chart is having. Okay, let's get into our main discussion. See, because you have a different, you have whatever the price you are having, same price in the, not the same price here. This price is different, futures price is different. That is what you have seen in Excel sheet. You have some 140 rupees, 150 rupees, 120 rupees difference you are seeing for each candle, right? So that's why when you are having the difference, you can't plan trade in this equity price. Equity price is different, future price is different. When equity price is entering into the zone, at that time, whatever the price is there, with that price you go for maybe some 0.1% buffer. With 0.1% buffer with the current price, you take a trade with the limit price. Mostly your trade will execute because you are keeping the trade. Suppose if you want to go for a short, 0.1 buffer just before you are keeping. Due to that, maybe you are paying extra 0.1% value. 0.1% is a negligible value. Here your trade execution is important. While stop loss also same thing. 0.1% buffer, some buffer to existing value, whatever the value is there in the futures price, add that value before that and you exit from your trade with stop loss. So this technique you follow when you are using the futures. Generally I follow the same. I don't mind losing extra 100 or 200 rupees extra 100 rupees loss also if I get, okay. Then the planned loss, say my planned loss is say 1200 rupees. Because of the buffer I am getting 1300 rupees loss. It is okay for me. I am not worrying about this 100 rupees or 150 or 200 rupees. But the time when we get the profits, we are getting 6,000 rupees, 7,000, 9,000, 10,000. That way we are getting profits, right? Compared to that, 100 rupees is nothing. Okay. So here whatever the price you kept, say blue color line, see price went beyond that blue color, your trade would have been executed, right? After that prices are coming down, coming down, coming down. And finally it reached your target. Let us assume, because you are using trailing stop, and this is until this 15-minute zone. Earlier 15-minute zones are violated. This 15 also should violate, right, according to our logic, but it didn't violate. Prices are moving up and down. Maybe you may exit here, or maybe you may exit, or you may exit, worst case scenario. Or another scenario, you are using 1 minute trailing. Suppose if this drop is violated in this candle, somewhere in this candle, you want to exit the trade. Let us assume this is 1046 candle. At 1046 candle, go to the, because 1046 your trailing stop is violated. So here in the 1046 candle, where it is? Here you have 1046 candle. Here whatever the price is there in the futures, with that price, if you want to, your trade has to be executed, add a little extra here. And you exit the trade. That's it. This is the simple logic. You are only looking into the zones. You are not looking into the price. You are looking into the zones in the equity chart. You are not looking into the price in the equity chart. When this price is reached in the zone, say for example here you want to exit at 1031 candle. So 1031 candle, this is the candle. Whatever the price in the futures chart, with that price you exit at that 1031 candle. Here you don't bother about the price in equity chart. See, the trade you have taken as per the futures chart price. Here also the trade you have taken as per the equity chart. See, let us assume you took the trade, price entered in which candle? Morning 927 candle. Here 927 candle. This is the one, 927. Let us assume somewhere here you took the trade. As I told you, here you took the trade. What is the price here? 31,070. 45 paisa. 31,070.45. At the time your trade is executed, let us assume. Okay. But actually what is the price at that place here? 30,949 in equity. But you have taken trade at 31,070 paisa. So that means you didn't bother about the price in the equity chart. You only seeing the zone. You are assuming in this zone, whatever the price in the future chart, the blue color line is the, let us assume, that is your future price. There you go for a short trade. So this is your short trade. And when you want to book the profit, the moment it reached in this candle, of course, not exactly you won't book. For easy calculations, let us say you booked your profit here at 1031 candle. So, and here, where is the 1031 candle here? So, somewhere almost closing of this market, you book the profit. Here you book the profit. And what is this value? 30,150. So, minus 30,150. 920 rupee 45 paisa, you got the profit for each stock. What is the lot size? Into 25. You got 23,011 rupees profit. It is almost same as the profit you got because I calculated in equity charts for easy explanation point of view. I always doing calculations on the equity charts, but in reality you do in futures charts. See, here you got 23,247 rupees profit. Now you get 23,011. See, what is the difference? Hardly some 200, 300 rupees difference. That's it. But almost same profit only you got, right? ROA also almost same you get. If not 17, maybe you get 16.9% you get, or maybe 17.1% you get. We have calculated 1,46,500, right? Yesterday we discussed 1,46,500 could have been our entry. So into 100 divided by 1,46,500. 15 point, maybe 45,500 maybe. Okay, anyway. Almost close to the same ROI we got. If we look into the chart, we get clarity. Margin calculator. So Sri Cement May month 1,36,000. This is maybe today's current price. So almost 15 points, almost 16% profit you got, ROA. That's it. See at 10:31, what is the price difference? 145 rupees between your, when you took the trade at morning, 927, 135 rupees difference is there between your futures price and equity price at the time of exit at 10:31, 145 rupees difference. So between 135 and 145, what is the difference? 10 rupees only difference is there. A 10 rupees increased in the premium value because of the volatility conditions in the market. That is within the 30% limit only, right? 0.1% is 30, 0.2 is 60. Volatility, that is 0.1% or 0.2%, that is volatility change. Because of the volatility changes, increasing or decreasing of your premium values within the day, within the intraday. So what I am trying to tell you, these differences, let us assume if your calculated value is 125 rupees according to this formula, let us assume the calculated value is 125. Let us assume. I am not confirming. Just assumption I am telling you. If that is the value, see the differences. The differences are either increasing value or decreasing value. Those differences are not more than 0.2%. 0.2% is a negligible value. So that's why, what is that I am suggesting? Whenever you want to plan your trade, do analysis on the equity chart. Whatever the price here in the morning 927 candle, because 927 prices are entering into the zone. Just before entering into the zone, you place your order. Whatever the price, here you place your order. Let us assume this is our target zone. Just before entering into the zone, whatever the price, let us assume this is the price, the blue color line. There you exit the trade, that's it. You need not take decision after entering into the zone. Just before entering into the zone, you take the decision. Because of the buffer values, slightly your profit margin may reduce, that is okay. Slightly your stop loss may increase, that is okay. See, anyway, most of the, your maximum accepted risk is 2%. But most of the times we are fine-tuning the zones, our risk will be around 1% or 1.2% or 1.3. Worst case scenarios, we are seeing 1.5. They are not going beyond that. Maybe one or two trades, a very rare situations, they go near to 2%. Rare. We haven't, hardly you see one or two for the last 1 year time period. Such kind of trades. But average majority of the trades are around between 1% to 1.2%. In that case, just for that 1.2%, another 0.2% is added. Because of that 0.2, your risk is going to be, instead of 1.2, maybe it could be 1.4%. That is okay. Okay. And if you are a pure intraday trader, if you don't want to take such kind of, these kind of even small margins also important for you, you trade in cash segment. Cash segment also brokers are giving 5 times margin. When you are using 5 times margin, make sure your risk will be less than 2%. Never take your risk beyond 2%. With the margin, you have to calculate with the margin risk, not in the actual market value. Yesterday I shown you the difference between price values with margin, without margin I have shown, right? Of course, I took the example future. Even if you take equity with 5 times margin also, the calculation spot what you learned in the previous video is also same. You won't see any difference. What is another one we have seen? Grassim. Grassim is also same. Here we got the trade. In which candle you got? Morning 9:16 candle you got the trade. If you missed, you got another opportunity in morning 9:27 candle or 9:28 candle also you got the trade. After that reached the target in 11:3 candle. Here pro gap is there. There you kept the target. So Grassim also open the chart in futures. This is the Grassim futures chart, and this is equity chart. Equity chart 9:16 we got the trade. So 9:16 when prices are about to enter into the zone, here in this candle, see this is the 9:16 candle. Maybe somewhere here, just before entering into the trade, this is the blue color line, whatever I have drawn, current price, let us assume. There are maybe few points below. You keep a you keep a limit order. Definitely your trade will execute. See, price is here, but before itself, you are keeping, below only you are keeping your limit order. Few paisa below this. This is a 2000 rupees stock. 2000 rupees stock, the differences here are not like 30 rupees or 40 rupees changes, what you have seen in the previous slide. You won't be seeing this much. Maybe half of this value, maybe 10 rupee, 11 rupee, 12 rupee differences you will be seeing here. Because this is 30,000 worth stock, you are seeing 55. And 2000 worth means 10 times less, maybe 11 rupees like that. That we will see. Whatever the price here, you take that price in futures price. You can't use equity price in futures chart. Equity only zone you are referring. When prices are entering in the equity zone, just before entering in the zone, whatever the price in the futures, this is equity chart, before entering into the equity zone, whatever the price is there in the futures, at that price you take the trade. And similarly, when you are exiting in which candle? Maybe at 11:2 candle you are exiting. At 11:2 where it is here. Is it 11:2 or 11:3? This is 11 o'clock 3 minutes. 11 o'clock 3 minutes. So 11 o'clock 3 minutes. So this is the candle. Maybe somewhere here you might have exited. Just before that. Then this futures, this is your entry and this is your profit booking. That difference will be your profit. And that profit almost you get same as what you calculated on the equity chart. See here, your entry price is 2747.30. Minus, here let us assume you exited here. Here the price is 2687. Each stock you got 60 rupees 20 paisa. Let us see what is the, I didn't remember the lot size. In 0 the margin calculator, let us check. So Grassim May month futures, current month is May. And this is today's value. The value may slightly change in previous value. It is a 250 rupees into 250. You would have got 15,050 paisa. But what we registered in our Excel sheet? 14,175. This is even more. Why? Because maybe the volatility might have been increased. It would have given you more profit. This one I calculated without any volatility inclusion by referring from equity chart. Why I am calculating from equity chart is because these are the intraday trades. Some people may do trading in the cash segment. But futures price, futures lot size I am using. Futures lot size and margin cost I am using for reference. Because equity also the margin more or less same, not much difference. To avoid the manual calculations, I am taking the reference from the futures. Because in 0 the margin calculator they display. So approximate value near the zones manually I am calculating. So these statistics are nearer to the closest values. Maybe here ROI you might have got futures a little extra ROI because here the value profit margin is less. You got 11.7, 14,175. Maybe 15,000, another 1,000 rupees extra, close to 900 rupees maybe extra. Maybe your ROI could be maybe around maybe 12% or 12.1%. Okay, that small 0.23% that is not important. But the point you should understand whether you are trading in equity segment or future segment with margin, the profit margins are almost, they are nearer. They are almost same. Not much difference. You may ask a question whether to trade in equity cash segment is better or to trade in future segment is better. See, intraday cash segment is better, no doubt in that. Because all these confusions, calculations part you can avoid. But at the same time, you have the disadvantage also. Cash segment may be at your broker's threshold time interval. That is maybe at 2:30 or 2:15 or 2:45. At the time, if you don't close your trades, automatically they will be closed. So that means before that time, you have to close your intraday trades. But futures, you have advantage, holding the trade till the last minute. Depending on the situation, you can close. Sometimes you can book your profit at 3 o'clock. If you have confidence that prices, you brought a share, prices will further go up. If you have confidence, if you have your own analytical reasons, you can hold. But that is not possible in cash segment. That is one. And another disadvantage in cash segment is going for shorts is allowed only in the intraday. And allowing that 5 times margin is also allowed only in the intraday. If you want to go for a short-term trade or if you want to go for a swing trades, you want to hold for next few days or next few weeks, that is not possible with 5 times margin in cash segment. And short trades are not possible. If you want to hold your stocks, short trades is not possible in cash segment. So that is possible only in F&O only. So that is the reason why at the time you have to take trades only in F&O. So at the time you should remember these calculations again. And options traders, the time decay also will be added. And options, the game is totally, the trading game itself is totally different. Unless you are an experienced in options, you have complete knowledge, you don't get into options. That is totally a different ball game. But futures, those who are planning in futures, this is the technique, at least this is the best technique. Analyzing in the equity chart, and whenever prices are nearing and you are exiting the trade. I mean you are taking the entry. Similarly, whenever prices are nearing to your target, just before that you are exiting your trade. So this is how you should plan. Similarly, when it is suppose if it is about to hit the stop loss, just before entering into your stop loss, you will be exiting in, or even after just crossed the stop buffer value. I mean the stop buffer value in equity chart analysis, whatever the value is there, a little far above, you will exit. Suppose you are supposed to exit at 100 rupees. So you will keep your exit point as 100 to 100 rupee 20 paisa with limit orders. You don't go for market order. If you keep the value above the current value and if you go for exit, definitely system will execute the trade. See, buying always you should keep a value before. Selling always you should keep the value after. This is how you should plan. Suppose you want to buy at 100 rupees. You should keep your trade as 100 rupee 10 paisa. Because the value is higher than what you are buying, definitely the value 100% your trade will execute. Suppose you want to sell at 100 rupees. Instead of keeping 100 rupees sell, you keep 99.80 paisa or 99.90 paisa. So that definitely your trade will be executed. So this is about the comparison between one more point I forgot to tell you. See, Grassim also I have added the values. Grassim also, morning 9:15. See the difference? See the difference between Sriram Cement and Grassim. Sriram Cement 9:15 candle, 260 rupees difference is there. Grassim 19.9% difference. See, this is the highest value entire the day. Morning 9:15, volatility will be very high. Mostly throughout the day, the value won't cross this much. 9:16, 17.1. 9:17, all of a sudden the value come down to 10. Probably your average value could be around 10. So throughout the day within the 2%, 0.2% above and below only it moved. I think around 5 rupee 50 paisa something it will come. Plus or minus, that is 0.2% of the current market value in the price. This is around 2000 rupees, right? Let us open the chart. See, this is the maybe average value. Let me take the value. Average value could be around 2 lakh. Not 2 lakh. 2000. 700. Say 20 rupees. Round value. Let me keep 2720. 2720 into 0.2%. That is 0.2 divided by 100. 5.4 up or down will be there. 2%, 5.4. Let us assume if 10 is the average value, 10.5 above, 15 rupees above and 5 rupees below, your price movement will be there. Just ignore the first few candles in the morning because volatility is high. Maybe 9:15, 9:16 you have seen higher values. Premiums are very high at morning 9:15, 16. Later on you see the values are within 15 and within 5 rupees and 15 rupees only. Say 10 point, let us assume maybe 10 could be around your here somewhat a little 16.2. Maybe it could be maybe 11 rupees or something might be there. I'm saying 10, but maybe 11 rupees. If 11, it comes. And below 6 rupees should be the least side. 10, 10. So here least is 6.6. So all are between 6 and 16 rupees, the price movements we have seen throughout the day. So that's why I'm saying the premium, see, volatility changes because of heavy volatility changes. The additional premiums values will be not more than 0.02% of your current market price of that particular stock. Hope you got the clarity now, and also hope you got the clarity how exactly you should plan your trades in future charts, but your analysis will be on equity charts. Why we don't analyze in the equity charts is mainly because the premium values during the month ending is almost zero, and during month starting the premium values will be very high value. Month means not the calendar month. I'm talking about your F&O month. F&O month ends last Thursday of a month. After that, even some more days are there in the month. That is the starting month of the next F&O calendar. See, for example, April, I think April 24th, our expiry date. But May month started from April 25 onwards, May month started. That is the F&O month. So that's why I'm saying it is not calendar month, it is F&O month. Now currently we are trading May futures. But the current today's date is May 26th. Sorry, not 26th, 28th, because Saturday, Sundays are there, no? So May 24th, Thursday, 25th, Friday, 26th, 27th, holiday, Saturday. And today 28th. Still you are in the April calendar month only. But our futures point of view, it is a May calendar month. So this is how you should understand. So this is about this is the end of the lesson. Hope now you got clarity about understanding the difference between future charts and equity charts. So if you have any questions, put them in the comment section of this video. Let's all meet again in our next video. Thank you.